Okay, now let's get into the performance evaluation for both private equity and real estate. So, as discussed already, that this displays a J curve, right? Where you first are putting money in, you're burning the dollar to earn the dollar. So it requires initial cash outlay, significant initial cash outlay, and takes a substantial amount of time for them to turn profitable, right? So clearly, you can't use short term performance measures. You need to use specialized performance measures, and we'll be looking at three of these, which is IRR, MOIC, and cap rate. Now, the problem with IRR is that it's based on cash flows, right? So it doesn't take into account the unrealized gains. And as I was telling you, that when you start putting the money in, that money is going to be improving the value of your assets. The investment that you've made will already be giving you some return. But if you're going to wait for the cash flows to show it, it's going to be a sort of a delayed mechanism, right? Because it doesn't take into account the unrealized gains. Number one. Number two, an inherent problem with IRR, which is, of course, a general thing, that IRR assumes that the interim cash flows, so during the life of the investment, whatever cash flows you are getting are being reinvested at that rate. So let's say the IRR you calculate for the investment and it comes out to be 18%. So whatever dollar values it is giving you throughout the life, right? Whatever, especially let's say it turns positive somewhere over here. So this cash that you got, this cash that you got until the end. So this, for let's say for over 2 years, for 3 years, are you going to be able to invest that cash at 18% as well? Whatever you got before the project was over, right? Is it possible for you to just go to the local bank and say, hey, can I invest this cash for 2 years at 18% per year? Most likely not, right? So that's the second problem with IRR. And this problem is a general problem with IRR, which is not only for alternative investments, it's for using IRR in any other investment evaluation, that it assumes that the interim cash flows are reinvested at the same rate, which is may or may not be actually earned. Well, most likely may not be actually earned, because the investment itself would be giving a higher return and you won't be able to find short term opportunities giving that type of high return. And finally, IRR is a rate, right? You need to compare it with your WACC to see and decide whether the IRR is good enough or not. On its own, IRR doesn't tell you anything. So that's the third issue with IRR. That is 18% good enough or not? Well, only when you calculate the weighted average cost of capital required for this type of an investment, which will take into account the risk of this investment, then you will know that, okay, given the risk, given the amount of risk in this investment, what is the return I'm earning and what is the cost of capital that I will have to pay, and is there some value that is being generated here or not? That brings us to the second method, which is a multiple of invested capital. And what I really like about this is that this takes into account the unrealized value of the investment. Is this the perfect method? No. Does it have limitations? Yes. But does it take care of that huge limitation that IRR had, that it was ignoring the unrealized value? Yes. And when it comes to private equity, that's really important, because I mean, you're looking at 5 years, 10 years of investments, and already in the first and second year, the investment would have started going up in value, but not in terms of cash flows. So, in the first few years, you might be thinking the investment is still not giving you returns, but it would be. So, therefore, MOIC would be a better measure, right? Especially during that part of life where the cash flows are negative. But then the drawback is that MOIC is ignoring the timing of the cash flow. So it doesn't really give better weight to the ones coming in earlier, and it doesn't penalize the cash flows coming in later. So that is true. But you give something up, you get something in return. So it's a bit of a trade off, right? This is something that we're going to expand at level 2 as far as the current curriculum is concerned, because the curriculum also changes, right? But currently in level 2, there is a very, very interesting calculation that we do for returns of private equity. And we use this type of an approach where we're taking the realized and we're taking the unrealized. So that calculation gets really fun. At your current level right now, you just need to know a very simple calculation, and I'll walk you through it. So let's say there is a fund that is investing 750 million, right? So in the denominator, obviously, we're going to start off with that 750. But we won't take that entire 750, because if there is any fees that is paid, that is deducted from it. Now, how much fees are we paying? The management fees is 2%, right? And it is going to be for 5 years, because we're going to look at the return at the end of the 5th year. So 2% multiplied with the invested amount multiplied with your number of years gives you 75. So you just minus that 75 from the original investment amount and you get 65. So that's why in the denominator we have 65. Now let's talk about the numerator. In the numerator, what happens is, and this by the way is from your curriculum, so if you want you can jump into the curriculum and see the entire question as well, but let me walk you through it for now. So what's happening in the numerator? We want the realized and the unrealized, right? So that's the beauty of this, that we get the unrealized as well. Now, how much is the realized? Well, it says that the fund has given a total of 1 billion back. So 1,000 million has been realized, has been distributed back to the investors. And another 500 is left, right? And that's unrealized, but it's there. It's there. It's your money. And if you take that into account as well, and that is what your numerator is going to be. So what you get is 1500 over 675, and that comes to a very nice 220% or 2.2x return. Well done, right? Next is cap rate, and I want you to link this with the Gordon growth model. So in the Gordon growth model, we do V0 is equal to D1 divided by R minus G, right? Now what's going on over here? Basically, this is what the cap rate is. R minus G is what we call the cap rate with respect to real estate. And I'll demonstrate that. And instead of the dividend, we take the rent. So what we are saying is that the value of the property is equal to the rent, right, divided by R minus G, which is the cap rate. So cap rate is just the required rate minus the growth rate. So that is going to be expanded in level 2 as well, right? But for now, that's what it is. It's very simple. And you can calculate the cap rate by making it the subject of the equation and bringing the value of the property down here, right? So I'm just bringing this here and bringing that there. And that's what's said over here, that the cap rate can be calculated by taking the rent and dividing it by the price originally paid for the property. So that's what's going on. Now, as we discussed with Hilton, with the Hilton deal, right, and your Blackstone coming in and buying this for 26 billion, of which only 6 billion or even less than 6 billion was theirs, and a little more than 20 billion was debt or borrowed, right? So clearly you can see that it is huge. The amount of leverage is huge. And this is a private equity deal. But alternative investments is more than private equity, right? You have hedge funds as well. So, I mean, hedge funds, especially the ones which are, let's say, doing a long short strategy. And what does that mean? So that means they will go long some shares, they will go short some shares, they will short sell some shares and cancel out the exposure. So in terms of market risk or beta, they will be beta neutral. So they don't care if the market goes up or the market comes down because they've hedged their risk, right? Hence the name hedge fund. But what these guys do is, let's say if they have 10 million in capital, they might take a 1,000 million or 1 billion position, like 100x leverage. Because the logic is that, hey, we've sold short as well. So even if the market crashes, the losses on the long position will be offset by the gains on the short position. So our risk is not really there. So that's why they take so much risk and so much leverage, so much borrowed funds. So we're going to look at how to calculate the return, because it will be amplified either way, right? If you're going to gain, it will be much more. So if just imagine if this increases by 1%, that 1,000 million, that means it's going to become 1010, and that 10 million profit is actually going to be 100% return on your original 10 million investment. So that's what it is. Now, I know this looks very bad, and I don't want you to look at this formula, right? Just ignore it, because I think it's much easier for you to just intuitively understand what we're doing over here, right? So I'll demonstrate it through an example, and instead of using your limited, see, because the way I feel is that our mind, it's like a computer hard disk and a computer short-term read-only and random access memory, right? So your computer might have like a 16 GB, it might have like a 16 GB RAM and like a 500 GB hard disk or a ROM. So if you understand things, then they can easily go in your 500 GB, right? But if you memorize things such as these complicated looking formulas, then they go into your 16 GB, but that is already much lesser space. And also this gets wiped out once you sleep, right? So like you reset your computer or you restart it. So this gets wiped out, and then again, it has to be, you have to load back the things, but this is permanently stored. So this is one of those concepts which I feel that you should understand intuitively and just put it into your 500 GB instead of trying to cram that formula into your 16 GB. There are formulas which you need to cram, right? But I believe this is not one of them. So let's see what's happening with this hedge fund and intuitively try to understand and remember how to deal with such calculations. So they're starting off with 100 million and they're earning 8%. Now, one thing you should immediately think is that, oh, if they're going to use leverage and they are having a positive return, this return will be enhanced positively by the leverage. And in the next scenario, in scenario 2, we will look at them making a loss. And again, this loss will be enhanced. So leverage will always magnify the gain or the loss. That is one concept that should be very clear in your mind. Now, how much leverage are they taking? 50 over 100, right? So they're basically taking 50 over 100 or 1 over 2 amount of leverage. Now, what is their return? The return is 8% on that 100 over 100, and it is going to be 8 minus 4%. Why minus 4? Because the cost of that money is 4. So obviously, whoever you're getting it from will need interest on that. So the 8% you're making on the amount that you have borrowed and invested. So the 8% you will make on this 50, well, it's not all yours. 4% has to be paid to the party, the bank, whoever, the broker you borrowed it from. So only 4% is your gain. And that applies to only 50 of that 100, right? So half of your return will be contributed. So first of all, 8 minus 4, the difference between the return and the cost, multiplied by the ratio of the amount of money you used and with respect to the amount of money that was your own, plus the rate that you earned purely for yourself, no cost over here, multiplied by the amount of money that you invested divided by that was your own. So now if you look at the formula, what's going on? The formula only shows you 8%. It doesn't show you that 100 over 100, right? So that's why I was saying, instead of looking at the formula because it gets confusing, if you intuitively try to understand what's going on over here, is that 8% is basically multiplied with 100 over 100, and that's 1, hence it's not written. But that is there. It's very much there. Plus the 8 minus 4 is multiplied with 50 over 100. And that is how you take your 8, because if this wasn't there, then you would only make 8, right? But you're making more than 8 because you're also making 8 minus 4 into that 50 over 100. And that is how you get 10, which is obviously more than 8 because your return gets magnified. Now let's look at scenario 2. The loss will be magnified as well, and clearly you can see it is going to minus 5 from minus 2. But let's see how. So that minus 2 obviously will be multiplied with 100 over 100. They're not showing that 100 over 100 over here, right? But it's there. And so if in absence of any leverage, this is what you would have made, the 2%. But you're going to have something more coming in, and what that more is going to be that 2% minus 4%. So you actually have a loss on this. So minus 6% because you lost 2% and you have to give 4% to the people you borrowed it from. So total, this will be negative 6 multiplied by 50 over 100. And that, my friends, gives you minus 5%. And you can see the loss is magnified as well. Right, and hedge funds do this a lot. Very, very dangerous. They leverage their portfolios using derivatives, such as using futures contracts, forwards contracts. So hardly any deposit is required, and they take huge positions in margin accounts with the brokers. The brokers that give them this type of service are called prime brokers. And the securities that they invest in, the cash that they have, is held as collateral with the broker, and this can magnify their gains or losses and even lead to something called a margin call. And I think if you're really interested, look into a story of GameStop, right? So one of these hedge funds, they short sold a share called GameStop, and the retail investors started buying it just to squeeze this hedge fund, right? So it's called a short squeeze, because when you short sell something, you have to buy it back and return it, right? But they were not able to buy it back and return it because the retail investors just kept pushing the price up. And then when they had to buy it back, they had to then push the price up even more themselves, which eventually led to a margin call from their broker, and they actually went bankrupt. So that's why short selling is very, very dangerous. The losses can be infinite. So you might think that you've got a long short strategy and you've balanced everything out, but then, well, it's not true. So leverage can actually wipe you out. So that is the use of borrowed funds. We're going to next talk about valuation. So what that means is, if you have some securities which haven't given you any cash flows, but they're there, and you need to know what is the value of those funds. Because if you're calculating your return and you're taking the realized portion and you're taking the unrealized portion, well, the unrealized portion needs to be valued. So how are you going to go about valuing it, right? And what's the frequency of the valuation, and what is the method that you will be allowed to use? Now, obviously the best is that you take the market price, right? So if you've got assets which are listed, publicly listed securities, well, you can take the market price. If it is a real estate, well, it gets a little bit tricky, right? You then need to decide what price to use, and that's where the US GAAP accounting standards are going to come in, and shortly we'll just talk about that. But before I talk about real estate and other things which require more sophisticated valuation methodologies, I just want to talk about these market prices, that should you take the bid or the ask. Now, a common practice is to take the average, but a more conservative approach is to take the ask for the short and bid for the long. Now, what does that mean? Let's say you have your long Apple shares, right? So if you want to value this position of Apple shares, which means what can you sell them for? So when you go to the market to sell them, the person bidding for them is the one who you can sell to, right? So that's why you take the bid prices for your long positions. And whereas, let's say you're short a stock like GameStop and you need to buy this to square this position, well, then you need to check what is the price people are asking for it if you want to buy it from them. So a more conservative approach would be to take the bid prices for the long and ask prices for the short. Now coming to the ones which are not publicly traded, right? So obviously the best is if it's publicly traded, price is available, just use that for valuation. and ideally use the bid for long and ask for short. But if the price is not available, then well, you need a quotation. So you need to talk to the broker and ask them, hey, can you please give me a quote so that I can value my investment? And if that is also not available, well, then you need to start using internal models. Now, that is where things get complicated, because if you're an investor and you're dealing with a hedge fund or a private equity or any alternative investment class, basically, and they are showing you the return with some part as unrealized gains based on the value of the investment, and they're using an internal model to calculate that value, there's some things that you need to be very careful with. Number one, that model may be inappropriate or inconsistent, so you need to make sure it is appropriate and consistent. Number two, the value that they might be showing might not be what the asset can be liquidated at, right? It might be based on the future cash flows of that asset or something like that, but not the current liquidation value. And number three, because the frequency of appraisal is not that frequent, so the returns and the volatility might be understated. What that means is, let's say the asset is actually like this, very volatile, but because you don't really appraise it very frequently, so what it looks like to you is this, when actually it is like this, right? So the volatility and the returns may be smoothed out. So that is your valuation. Of course, you need to take into account fees, and this is going to be a long discussion, and we're not going to do it on this slide. We're going to have, let me just show you, we're going to have an entire calculation of returns coming up, and we'll get into that. But what this slide is basically showing you and telling you is that you need to take the fees into account as well, right? So the return that you're calculating has to be seen in terms of the after fees or net of fees, because there's a lot of things that can happen over here. So first of all, if you're coming in early at the time the fund is being made and you're negotiating with the fund manager that, hey, I'm going to give you a lot of money and I'm not going to even ask for it back for a long period of time, so I'm willing to accept greater restriction on redemption, and I'm giving you a significant amount of capital, so please give me lower fees, right? So that fee could be low for you if you negotiate accordingly. It could be very high for you if you enter later when the fund has already declined, because when it will go up, the manager will say, oh, you entered at 50, you're exiting at 100, so before you exit, please pay me a certain percentage of this profit, right? Compared to somebody who entered at, let's say, 80, will have to pay a smaller amount and you will have to pay a bigger amount. So even though you're gaining more, but the fees will be higher for you, which I think is not bad, because I mean, in net amount, you'll probably still gain more than this chap. So not a bad idea to enter once it crashes, but then just keep in mind that your fees will be higher than the one who has been there from the beginning. So all of this will become more clear when we get into the return calculation, but that will not be now. It will be in the next one. So let's stop here, take a break, get fresh, and then let's come back and get into the return calculations.